With US payrolls, PMIs, Eurozone CPI and UK current account, anyone hoping for a slowdown before the Easter holidays may have to change their forecasts. So, to help you keep on top of your trades this week, I'm chatting to Nick Stamenkovic for the Dukascopy week ahead. So, Nick, we've just had German inflation suggesting the country is out of the deflation trough. How does this play into the euro and indeed global deflationary discussion? Will there be more good news tomorrow? And should we be hoping for any action indicators from Thursday's ECB meeting minutes?
But overall, deflation fears have ebbed because of the weakness of the euro, because of the ECB's significant policy easing and sovereign QE. But the economy itself is still growing at a pretty sluggish pace. The output gap is quite sizable. The unemployment rate's only coming down marginally. So core inflation is going to remain pretty low for some time. So I don't see any quick rise in inflation anytime soon. I think it'll be a very gradual increase. And the ECB itself doesn't see the 2% target being reached for some years to come. Hence, they will maintain a very accommodating stance for quite a few months.
Japan's industrial output fell in February at the fastest pace in 8 months. Now, business sentiment has been described as patchy due to the effects of a weaker yen, but how influential would another disappointing figure be from Wednesday's Tankan report? And do you think this will be the case?
Well, certainly industrial production figures were disappointing, but these figures are very volatile on a month-to-month basis. If you look at the underlying trend, we are seeing a steady improvement in the corporate sector in Japan. And I think we'll see, steady as she goes in terms of the Tankan survey for Q1 for the first quarter of this year. What's interesting is that the weakness of the yen does seem to be filtering through to the trade side, and we have seen a better picture on exports. So net trade should be more of a positive support going forward. But the consumer sector has been somewhat disappointing, as you saw the household spending figures last week. But the key issue for the Bank of Japan is deflation. And as you saw last week, the underlying rate taking out erratic items is close to zero. And if we continue to see downward pressure in inflation, then the BOJ will probably have to take more measures, if not in the summer, then in the autumn. And that means probably expanding its balance sheet, not through sovereign bonds, which are already distorting the market hugely, but more likely through equities, ETFs. And as we've seen recently, the yen has been pretty stable against the dollar. But I think over the medium term, if the Bank of Japan does go down further, which I think is likely, then the yen's likely to come under further downward pressure.
For all that the ADP employment estimate is not the official report, the fact that most participants will not be present for the official release may elevate the ADP estimate. Analysts say even a reading closer to 200,000 would keep the FOMC on course for a June Q3 rate lift-off. But what are you expecting?
I expect a pretty solid employment report in the US. I'm looking for the non-farm payrolls to rise 250,000 in March. I think the unemployment rate probably unchanged at 5.5%, but there are risks to the downside. The key aspect will be where we see any signs of wage pressures, which have been very subdued recently. But if you remember when Yellen spoke at the last FOMC meeting, he said that they could even raise rates even if wage pressures aren't rising significantly, if only gradually. So I think a solid employment report and signs that inflation is going to move towards the target over the medium term could still be sufficient for the Fed to tighten at June's FOMC meeting, though I acknowledge it's a pretty close call. But overall, the market is anticipating just a gradual rise in rates, and even if they don't raise rates in June, they will raise rates before year end, in my view. And hence, I think that that the Fed will continue to move towards normalising monetary policy. And indeed, we saw some comments from a number of Fed officials last week, suggesting that, or consistent with the idea that they are gradually moving towards raising rates. With one member, Mr. Lockhart, downplaying the impact of the stronger dollar on the U.S. economy. So, all in all, if labour markets continue to improve, and we see the core inflation rate, inching higher towards that 2% target, then I think a June rate hike should not be ruled out.
With all the events and data releases we have mentioned, which currencies should our viewers keep an eye out for?
Well, what was surprising last week was the performance of the euro. The dollar was on the defensive following the FOMC meeting, but there seems to be a little bit of a reassessment. And even though the data in the euro area is quite good and surprisingly upside, the euro failed to hold above that 110 level. So if we saw a strong employment report this week and we saw a further fall in the unemployment rate and the markets increased the odds of a June rate hike, then I think the dollar could get a lift against the euro. So I still think the dollar is the most important currency to follow. We've seen a rally in some of the other currencies, particularly emerging markets, against the dollar, but I think that's a temporary reprieve rather than anything more significant. So I think the dollar will continue to strengthen over the medium term as the Fed hikes rates in either June or September, whilst other central banks, particularly the ECB and the Bank of Japan, continue to pursue a very accommodating stance.
Nick, great to speak with you as usual. Thank you. Well, viewers, keep up to date with how these and other main events play out this week by staying with us here at Dukascopy TV. For me and for now, though, it's goodbye.